Thank you everybody for being here. I'm really excited about today. We have Chad Dziedzic. We've known Chad for many, many years. He's been a part of kind of the SageSpring family since I've been here. So you've probably supported us and given us just good tools and resources for over 20 years. And Chad, he probably won't brag on him the way I would. He's been a leader in the industry. He's been one of the go-to guys for us. He knows his stuff. You know, when we look to hire people, we look for people that are hungry, humble, and smart. And I just think about Chad. Chad checks all those boxes, and he's also easy on the eyes. He's a very good-looking individual. He probably didn't want me to say that, but we're honored to have you, Chad. Thank you for being here. Thank you for all of our friends and clients that are joining us. I know there's been a lot going on in the markets recently. I don't want to take too much time away from you, Chad, so I'll turn it over to you. Real quick before I do, the last thing I just wanted to mention is this is a typical webinar. I think everybody's cameras and microphones will be muted. We'll just hear from Chad. If you do have any questions, feel free to type any questions in the chat, and we'll try to get to those as we can. And I'd love to hear from you too afterwards, kind of what you thought. You know, if this is a good use of your time, which I'm confident it will be. If you want to hear more of these in the future, what cadence, what makes sense. But thank you all for being here. And without further ado, Chad, take it away.
All right. So, Brian, thank you for the introduction. I think I'm going to have you just come introduce me for every event. And I need you to tell my wife all that stuff, too. So I'll bring her in here at the end. No, I'm just kidding. But yeah, I mean, you guys have been like family, right? I mean, my house is about 2 miles from your office. And I love the passion that you guys have to serve your clients. And so it's a blessing for me to be able to partner with you guys to just provide some education to your clients. So I've been in the business for about 24 years. I've been at BlackRock for 14 years. I've delivered over 2,500 presentations on the market and Social Security. And, you know, Brian, for some unknown reason, I chose the one career that when everything goes on sale, everybody runs out of the store. So I tend to do most of my talking when the market gets crazy, and I don't have to talk as much when the market is doing well. So let's break down what's happening now. And this is coming directly from the CEO of BlackRock and the head of BlackRock Fixed Income, Rick Reeder, who I got to spend a couple of days with a few weeks ago. He also spoke at a huge event that we did in downtown Dallas that I know Jordan on the team got to attend, which was awesome. And there's really 3 words that we use to describe the market today. And I'm going to break each one of these down for you guys. And then, like Brian said, if you have questions, put it in the chat, put it in the Q&A, and I'll do my best to answer them. But the 3 words are perspective, bifurcation. It's a fancy word Rick likes to use. And then income. Okay. So I'm going to break the whole world and what is going down with these 3 words. So the first thing is perspective. I think to understand markets, you need to have perspective, right? So going back to 1928, the market makes about 8 to 9% per year, okay? Over the last 40 years, the market's made around 11 or 12% per year. The last 10 years, the market has made about 15% per year. The last 2 years, the market has made over 20% per year back to back. That has only happened like 4 or 5 times in history. And the point of me starting with this is, Brian, this isn't normal. Like, it's not normal to make 15% per year. It's not normal to have back-to-back 20% years. And what's funny, the last 2 years, I spent most of the beginning of the year, Brian, talking about recession. Like, we're heading into a recession. And then the market goes up 20%. So typically when the market does the best is when no one thinks it's going to do great. Coming into this year, I was scared out of my mind, to be honest with everyone, because everybody was positive because we had 2 back-to-back 20% years, and now everybody's a bull and everybody's ready. And now look what's happened. So when I say perspective, like, what is happening? I think this is similar to, so at the beginning of the year, I started, like many people do, I said, I'm going to get in great shape, right? I'm going to start lifting really heavy and I'm going to start eating really healthy. And Brian, after about 5 days, I felt so good. I was sticking to it and it felt amazing. But I looked in the mirror and I saw no changes, 0, right? And it's like, man, this kind of sucks. Or you do some kind of detox or anything. And for the first 30, 60, 90 days, it stinks. It's awful. And I would tell you that's what we're going through right now. This is a detox. We have been addicted to government debt. We've been addicted to government spending. Until last year, we were doing COVID level, emergency level spending like we were still in the pandemic. But we're not in the pandemic. And so we have to reduce our reliance on government spending and government debt. And that's why you're seeing Elon Musk do what he's doing. That's why you're seeing Scott Bessent do what he's doing. These guys have a mission. They know it's going to stink for the next 3 to 6 months. There's going to be a lot of volatility, but I think it's going to create a huge opportunity moving forward because it's going to allow what makes the United States the best country in the world to stand out. And Brian, that's the capital markets and the private markets. So when you need to solve a problem, you need to build data centers. Great. The government shouldn't do that. Private companies should do that. So now read about NVIDIA and Microsoft and Elon Musk and BlackRock and all these big companies are getting together to bring the money together to design and build data centers and to have natural gas facilities to power them and looking at nuclear again, which I think we need to do. You're seeing them figure out how to cool these data centers. And so, like, to go back, when I say perspective, I think we have to understand, like, we're going to have to do some tough things because I think everyone, regardless of your political party, like, we're on an unsustainable track when the debt has gone from 18 trillion in 2019 to $36 trillion today. It's just unsustainable, and we don't want that to be where we're drawing growth from. And so I would just say perspective, you're going to have to set expectations that we're not going to make 15% per year the next 10 years. We're probably not going to make 20% this year. But I think we're not heading for a recession, and I think the economy is really strong. But this is like when you go on a diet or you start working out, your body's sore, it stinks, you're hungry, but it's going to take some time. But if you keep doing the right activities for the next 3 to 6 months, you're going to see some big changes. And that's what our leadership really believes. If we stick to the plan and do the right things that we're doing now, you're going to see big results over the next several years. And so I wanted to start with that. The second word is bifurcation. Okay, and like I said, this is Rick's fancy word. He loves to use this word. Larry Fink uses this word, so I like to use it because it makes me sound smart too, I guess. So Brian, what's the easiest way I would explain the world today? I would say, let's say we have a family that makes $100,000 a year, and they have a 3% 30-year mortgage rate. And over here, we have a family that makes the same $100,000 of income, and they have a mortgage rate of 7.5%. Brian, these two families make the same thing. They are living a completely different life. And this is what's happening in our economy today. When you have higher interest rates, see, the other thing, when you look back 15 years, the average interest rate by the Federal Reserve was under 1% because we had close to 0% interest rates for a very, very long period of time, which allows low quality companies, high quality companies to borrow money cheaply. It allowed people to borrow on their homes cheaply. And now we're in a stronger economy with higher interest rates. And because of COVID and the inflation from it, now we've got inflation at 3% and interest rates around 4.5%. So it becomes the companies and the people that need to borrow money are going to be at a huge disadvantage from those that don't. And what Rick Reeder always says is the largest, best companies in the United States, they don't need to borrow any money, zero. So they're not borrowing anything now that interest rates are 4.5% or 5%. But if you're a small business, you need to borrow money. But if you're a small business that doesn't have perfect credit, you're not borrowing money at 4.5% or 5%. You're going to borrow money at 8% or 9% or 10%. You can look up a high yield bond fund. It's going to yield 8 or 9%. Well, guess what? That's small businesses borrowing money that are wrapped up in that index. So the lower quality business is going to be at a huge disadvantage because they have to borrow money where the large high quality company doesn't need to borrow any money. Now let's flip it on the other side. Amazon, NVIDIA, Meta, Apple, these companies on average have $100 billion in cash. So not only are they not borrowing money, they're sitting in cash making 4.5% or 5%. Rick Reeder, the head of BlackRock Fixed Income, manages money for 3 of the Mag 7. They keep a 6-month to a year emergency fund and they manage that in-house. We manage their 2 to 5 year capital. And on average, that portfolio is yielding about 6%. So think about that. A company on average sitting there with $100 billion in cash making 6% versus a small business that doesn't have any money to invest and has to borrow money at 8 or 9%. So when I say bifurcation, this is what I mean. When you have higher inflation, a strong economy, and higher interest rates, when rates are unlikely to go down, they may go down 1 or 2 times this year by the Fed, but it's likely to be a small incremental cut in interest rates, not enough to make a big difference to these companies. The last thing Rick Reeder, the head of our fixed income, talks about at BlackRock, his daughter's a buyer at Walmart. So think about this. The biggest companies have the best analytics. They have the best data. They use artificial intelligence that will blow your mind. So at Walmart, she knows exactly what to have on the shelf for Easter. She knows what to have on the shelf 6 months from now and exactly what consumers are buying and what they bought in the past. And then think about a small business trying to compete with all those analytics and big data and artificial intelligence. They don't have the same resources. And so, Brian, this is creating this bifurcation in the economy where you have big winners and big losers. So you have to be careful that you're not just investing in the total market because there can be a big dispersion between these companies. Now, I'm going to try to share this. Brian, will you let me know if that popped up? I know some people may not be able to see the screen, but this is a chart that shows the debt maturity schedule for the S&P 500. So 46% of the debt in the S&P 500 does not mature until at least 2030. The reason this is important is because these companies issue 10-year debt most of the time, okay? So why would it mature after 2030? Because they issued the debt in 2020. Well, what happened in 2020? In 250 years of bonds trading in the United States, interest rates have never been lower than August 4th of 2020. The 10-year Treasury yield in the United States was 0.52% on August 4th of 2020. So if you're a large US company with a great balance sheet, what did you do? You borrowed money like crazy. You didn't need to borrow the money, but you could borrow the money for 0.5%, maybe 1% for 10 years. And that's why so much of this debt matures after the year 2030. But if you look at the debt that's floating or matures in 23 or 24 or 25, what is that? Those are mostly, smaller businesses. They're companies in the S&P 500 that have bad balance sheets. They could not term out their debt the same way, and that's creating this bifurcation in the economy, okay? So when we're investing and when we're working with Brian and his team, we want to make sure we're positioned in the very high quality companies with the best balance sheets that don't need to borrow money, and we stay away from some of the smaller businesses that are highly levered and depend on borrowing money because they're going to be at a massive disadvantage, okay? The last thing is income. Okay, so over the last 40 years, we've seen something pretty dramatic happen. In September of 1981, the 10-year Treasury hit the highest yield ever. And I bet there's folks on the call that remember their mortgage rate in the early 80s. Or maybe you're like me, your parents have told you about this. My dad told me about their 16, 17% mortgage in 1981, 1982. I grew up in Houston, Texas. My dad worked at Anheuser-Busch. But a lot of my friends, their families worked in the oil business, and because of the bust in the early 80s and the high mortgage rates, a lot of my friends lost their homes. I was only 5 or 6 years old. I will never forget it. I'll never forget it. And so interest rates were 16%. And August 4th of 2020, interest rates were 0.5%. So bonds are like a seesaw, right? So you got the yield way up here and the yield comes down, the price goes up. So for 40 years, most of the return we made in fixed income came from falling interest rates. We sit here today and we're sitting here with a 4 to 5% interest rate. Most of your return in fixed income is now going to come from income, not from falling rates. And so we believe this is a time where we want to take advantage of these higher yields. We don't think stocks are going to make 15% per year. We think they make 8 to 9 to 10% per year. kind of a reversion to the mean. But what's amazing in fixed income, I don't have to take a lot of risk and I can make 5 or 6% without taking a lot of risk. So today, bonds are actually a really powerful tool that we can use to help provide cushion to the volatility in the equity market because the yields are so much higher than they've been the last 15 to 18 years. Because after the global financial crisis in 2008, interest rates were close to zero for much of that time until 2022. And so now today we have a great opportunity to utilize income to produce return and help us reach our goals and objectives. So Brian, those would be the three big topics. Going back to perspective, like you have to understand there's a big difference between the market and the economy. So I think the economy, we're doing the right things and eventually the market will realize that. But today the market has a lot of uncertainty. It's like when you get into cloudy water, right? I grew up in Houston. I thought the ocean was was Galveston, right? And the water's pretty murky. It's not clear. It's hard to see. That's what the market's seeing today. It's really cloudy. There's a lot of uncertainty. We're not sure like what's going to happen. And that's why the valuation for stocks has come down because of the level of uncertainty in the short term. Okay. And so just know you're probably not going to make 20% like you did the last 2 years. You're probably not going to average 15% per year the next 10 years. We don't see a recession, but I think returns are going to be lower than they've been the last 15 years. And then just remember bifurcation, right? There's a big difference. You want to make sure I don't just own the market. I'm actually being very careful where I'm investing in the market because there's going to be certain companies that have a massive advantage if they don't need to borrow money. Same thing with consumers. We try to invest in companies that are more dependent on consumers that don't need to borrow money. Okay. And then the last part, the most exciting thing going on today, if I told most of you a few years ago, hey, if you could make 6 to 7%, how would you feel about that? Great. Awesome. Well, guess what? Fixed income is now going to provide that type of return for you. And we haven't seen that in 15 years. So although we've seen a lot of volatility this year, you would think the world was going to end with the headlines. The market's down like 1% for the year, including today. Okay, so just know the media's job is to keep you in a constant state of fear and panic. So I'll finish with one of my favorite charts of all time. It's called There's Always a Reason to Sell. Okay, there's always going to be a negative headline. And these are all the terrible headlines going back to the GM Chrysler bankruptcy. Remember the BP oil spill where they had the camera at the bottom of I was like, I can get rid of my swimsuits. I'm never getting in the ocean ever again. The Ebola virus, that happened in Dallas. I was near that hospital that day. I came home, watched the news. I told my wife, I think I might have Ebola. She's like, you're an idiot. Like, you don't have Ebola. But that's how the media makes you feel. And you look through all of these different things. What's amazing, since March of 2009, the market is up 800%. So I mentioned my dad worked at Anheuser-Busch. So growing up, he was in a fishing club and we used to go fishing at all these different lakes all over Texas. My favorite thing about my dad working there was getting to go on these trips with my dad. Well, one time he took me offshore fishing in the Gulf of Mexico, Gulf of America, whatever the heck it's called today. But I didn't know, like I didn't know the difference in the ocean. So we go out 4 hours. Everything was fine on the ride out. When the boat stopped, we were literally doing this. Okay. And what did my dad saw me panic? I panicked. I'm 10 years old. I thought I was going to drown. These guys are all getting their fishing gear. I'm like, fishing? What are you guys doing? My dad puts his arm around me. He's like, son, if you keep looking at those waves next to the boat, you're going to get sick. You're going to have a bad day. We're not taking you back. And these dudes are going to laugh at you forever. And I was a pretty witty little guy. Then I was like, well, what's option 2? Because that sounds terrible. And he's like, look out on the horizon. You got to stop looking at the waves next to the boat. Focus out on the horizon. And if you do that, you're going to be just fine. But if you keep looking at those waves next to the boat, you're going to get sick. Well, I got deathly sick. I'll never forget that day. My dad's buddies still laugh at me, but I get the last laugh because every time something happens with the market, I'm able to tell them, hey, stop looking at the waves next to the boat, right? Right? You got to focus out on the horizon because I think the things we're doing today, the detox we're going through right now is the right thing. And I think it's going to set up the best thing about America, which is our capital markets. That's why America is the best. We have a free market system, an open market, a capital market system, a private market system that is better than anyone else. We have the best workers, the best technology. If a problem in the world needs to be solved, it's going to be solved right here in America. So we're going to continue doing great things. I would just tell you, don't look at the waves next to the boat. It's like the famous Warren Buffett quote, right? The market is the most efficient mechanism anywhere in the world for transferring wealth from impatient people to patient people. So we see this as a great opportunity over the next month or two. It's going to be bumpy. It's going to be a lot of waves, a lot of uncertainty, but I think over the next few years, the market should do extremely well. So Brian, I landed the plane at about 20 minutes, which is what I wanted to do. Keep it short, sweet, give people some talking points. Happy to take any questions if you think, hey, there's things coming up I'd like for you to address this, or if anyone on the call wants to put anything in the Q&A, please go for it and I'll be happy to answer it.
That's so good, Chad. Thank you. Thank you for being here. Thank you for doing this. It's always good. I get fired up listening to you. It's just like, yeah, America,
America,
I just
yeah.
It's so good.
Yeah.
And I know
but
we
it's
were
true,
talking,
right? I mean, that's the thing. It's like, yeah, it's like, but it's true. We're so blessed. We live in the best country in the world. There's nothing close. It's just not even close. So like, it's like, so yeah, happy to take any questions, and I'll pull one last thing up because I want you to see how serious our firm is about, what's going on right now. Our CEO wrote an op-ed in the Wall Street Journal the day of the election. And so he's been very involved, and I'm happy to talk about some of this. But here's what Larry Fink wrote on election morning: how to grow out of America's debt woes. You can Google this and go read it. It was an op-ed on election day. Why did he write that piece? And what do you think Trump and Scott Bessent and Elon Musk are doing? Get the government out of the way and let private corporations figure out the problems, because we have the smartest and best companies in the world that will win any battle we're going to end up with against China. The battle is going to be for artificial intelligence. And so our firm is all in. That's why you see us buying the ports on both sides of the Panama Canal to help our country. That's why you see us investing in the Texas Stock Exchange. Like, our firm is all in to help businesses in the United States, right? So pretty exciting time for us at BlackRock.
So good, Chad. Thank you. Thank you. Thank you. Thank you. This is so good. I don't see any questions. So I'll take that to mean there aren't any questions. If there are any questions, as always, we're always here. So reach out to myself, Jordan, Melanie. We're here because of you. And we just, it's worth thanking you. We just thank you for your business, for your friendships. And sometimes this is scary. Sometimes it's difficult, but we get through it and we're better for it. And we've been there before. This isn't the first time we've seen volatile markets or things to be a little bit shaky or anything like that. And I think the way that Chad tees us up, it's an exciting time. There's a lot of really good things coming out that we haven't seen ever. Just new stuff, new technologies. It's incredible what's going on. It's fun to be a part of. And if there's anything you need or conversations that you want to have, if it's time for a review, get in here. Let's talk. Let's reconnect. We've had a lot going on the last 6 to 9 months or so. All good things. We're positioned better than ever. So we're here for you. Reach out anytime if you need anything. We're always here. But thank you for your time. Let me know what you think. If you want more of these, really interested in just some feedback. So again, thank you for just being clients of SageSpring, Chad. Thank you for your friendship and for just always making us look good and smart. I mean, you're great at what you do, and we always appreciate you. With that, you guys have a good rest of your night. It's a beautiful day. I see bunnies and birds. It's like an incredible spring day. I think we get 3 per year. So go enjoy it.
All right. Take care, buddy. Thanks for having me.
I appreciate you. Take care.
Take care.